So I want to thank everyone for taking time out of their schedule to join us today. Just a couple of housekeeping items before we get started. This webinar is being recorded and you'll receive access to the recording afterwards via email. Also, we'll have a few minutes at the end for Q&A, so I would just ask that you please hold off with any questions until the end of the presentation. So before we get into the substantive material, I'd like to just give you a little bit of background on Foundation Source. So we've been around since 2000. I've been with the company since 2006. I'm based in New York and we're headquartered in Connecticut, but we're really across the country. We have over 2,000 clients across the various states. We are the largest provider of foundation management solutions in the nation. We currently have over 21 billion in assets under administration, and over the years, we've helped process over 12 billion in grants for the causes that matter most to our clients. We serve both family and corporate foundations. We take care of everything to keep the foundation running smoothly so that our clients can focus on their philanthropy. For example, we provide compliance at the point of transaction for all transactions that are processed through our system. In fact, I've personally helped design some of the built-in compliance checks that we have in our system over the years. Plus, we have a staff of compliance experts that are available to answer questions on any anticipated foundation transactions or activities. We track all transactions and asset information, and we also prepare federal returns and state filings, just to name a few. Our technology platform, which is called Impactfully, is second to none. It enables clients to access all the information about their foundation at the click of a button, whether it's grant history or key foundation documents or simply tracking the 5% payout requirement. And of course, each foundation has a private client advisor that they can call directly with any questions. So whether a foundation is big or small, or it's brand new or been in existence for many years, or if you need us to provide a foundation for you, Foundation Source has the technology and expertise to make giving easy and worry-free. Now let's get into the technical stuff. So here's a sneak preview of what we're going to cover today. First, we'll review some of the key tax benefits of having a foundation, including income tax savings and avoiding capital gains taxes. Then we'll focus on the 990PF, which I always say is kind of its own animal. It's called an information return, but it's not just an information return because it's also used to report things like violations such as self-dealing and taxable expenditures. And while it's not an income tax return because foundations are exempt from income tax, an important component of the return is calculating the foundation's net investment income and the related excise tax that foundations pay on the investment income. So in short, the form is complex and it seeks to cover a lot of ground. And unfortunately, the IRS instructions don't make it any easier because a lot of times they can be unclear, unhelpful, and sometimes just downright confusing. So with few exceptions, there aren't many return preparers out there that have the opportunity to prepare more than a handful of 990PFs every year. So there's really limited opportunity to gain meaningful experience in preparing the return. If you're a return preparer, your clients will be looking to you in deciphering the form and in understanding how the compliance rules fold into the return. But whether you're a return preparer or not, the key points that we'll cover today are bound to be top of mind. And so what we'll talk about is the foundation's tax liability, whether the foundation satisfied its payout requirement, how to calculate next year's payout requirement, and also reporting foundation violations. One of the most immediate tax benefits of having a foundation is an income tax deduction of up to 30% of adjusted gross income, or AGI, and up to 20% for donations of non-cash assets. Whether donating securities and other investment holdings or donating cash to the foundation so that it can purchase such investments, any income or appreciation that occurs within the foundation won't trigger any income tax liability for the donor. And any income generated within the foundation will only be subject to a 1.39% excise tax. Now let's talk about capital gains for a moment. When contributing highly appreciated assets to the foundation, donors are not responsible for any capital gains taxes as they would be if they had otherwise sold the asset instead of donating it. And so if and when the foundation decides to sell the asset, it would be subject to the capital gains tax, but it's only at the 1.39% tax rate. So the nice thing about this is that not only does this allow the donor to avoid a potentially significant tax bill, but because the foundation is exempt from income taxes, it's paying a much lower tax bill, which means that there's less money going into the IRS's pockets and more money available for charitable purposes, which I think we can all agree is always a good thing. Now, regarding estate taxes, when assets are left to a private foundation, they're excluded from the donor's estate, meaning that they are not subject to either federal or state estate taxes. Now, regarding the federal estate tax, if an individual were to pass no more than the federal exemption amount to family members other than the spouse, for example, and leave the remaining assets in the estate to a charitable organization, such as a private foundation, then the donor could potentially avoid all federal estate taxes entirely. Now onto the 990-PF. As we track the key data points I mentioned earlier, we'll cover the most common pitfalls that we see on the 990-PF, so you'll feel confident in being able to avoid them. And even though we'll be bouncing back and forth to the different parts of the return, we're going to approach it in a logical order, and by the time we're done, we'll have covered all the key important points. As we go through the 990-PF, you'll see screenshots, and just bear in mind that all of those screenshots are from a 2022 foundation return from a foundation on a calendar year end. So although foundations are exempt from income tax, they do pay an excise tax, as I mentioned, on net investment income. The excise tax rate is 1.39%. It's a flat tax rate. Just as a historical aside, it used to be a default tax rate of 2%, and foundations would have the opportunity to qualify for a 1% tax rate if they were able to satisfy certain special distribution requirements, which are separate and apart from the usual 5% payout requirement. Fortunately, however, the IRS decided finally a few years ago to just simplify things and apply a flat 1.39% rate across the board. Net investment income is a foundation's gross investment income, which includes things like interest, dividends, rents, royalties, net capital gains, less any investment expenses. So note that long-term and short-term capital gains are taxed at the same 1.39% tax rate, and that the excise tax rate will apply to capital gains regardless of whether the asset in question was an investment asset or a charitable use asset, which we'll talk about more later. Also, we have to remember that capital losses can only be used to offset capital gains and not other types of income. And it's also important to remember, specifically in the context of foundations, that unlike with individuals and businesses, capital losses cannot be carried forward to future years. So they're considered trapped in the return year. They can't be carried forward. Another matter to consider is that private foundations, like other exempt organizations, can have income that is tainted as unrelated business taxable income, or UBTI, which income is taxed at the for-profit rates. Most commonly, foundations encounter this when they invest on margin or where they have an interest in a partnership that allocates a share of flow-through income to the foundation. Foundations don't pay the 1.39% excise tax on unrelated business income. It's only taxed at the separate for-profit rates. So now we're looking at an excerpt from the first page of the return, and every column on this page has a specific purpose. The first column, entitled Revenue and Expenses per Books, is really just a straightforward financial report of money coming in and money going out. It doesn't assign any character to the revenue or expenses. Then we move on to the second column, column B, which calculates the foundation's net investment income, which again will be subject to the 1.39% tax rate. So the top half reports the foundation's investment income, which again includes interest, dividends, rents, royalties, net capital gains, while the bottom half reports any investment-related expenses that can be used to offset the investment income. Note that any expense that's identified in this column as an investment expense cannot also be used to satisfy the foundation's payout requirement. Now, the third column, column C, entitled Adjusted Net Income, is really used more by operating foundations and very rarely used by non-operating foundations. It's only used by non-operating foundations in the event that they have an active charitable program that generates revenue. The fourth column, entitled Dispersements for Charitable Purposes, is where the foundation reports any qualifying distributions, which could be grants or also qualifying expenses. The theme here is leaving money on the table or paying more taxes to the IRS than necessary because the foundation may have failed to report investment expenses and apply those to offset its investment income. As I mentioned earlier, a foundation cannot treat the same portion of an expense as both a column B and column D expense, meaning it can't be both an investment expense and a qualifying distribution. However, all too often we see foundations doing just that, where we see the full amount in both columns B and column D. And although the foundation's excise tax liability itself is a type of overhead, it can't be used as a qualifying distribution to satisfy the foundation's minimum distribution requirement. Interestingly, it also cannot be used as an investment-related expense to offset net investment income. So the excise tax liability really only appears in column A as money leaving the foundation, but it can't be classified in either of the other two columns typically used by non-operating foundations. Finally, we often see foundations incorrectly reporting income classified as, again, unrelated business taxable income, or UBTI, in column B. It's really only supposed to appear in column A because it's taxed at the separate for-profit rates. So it should not be reported in column B because that would have the effect of sort of a double taxation, because any unrelated business taxable income is really meant to be fully reported on a separate form called the 990T, which is where the foundation reports its unrelated business taxable income and also the tax, with the higher for-profit rates on that form. Now, just a quick glance at capital gains and losses. This table in Part 4 requires the foundation to distinguish between capital assets that were purchased by the foundation and those that were donated to the foundation. When calculating capital gains on the sale of a donated capital asset, the foundation is required to use the basis of the donor, which the foundation inherited at the time of the donation. Now, many foundations don't realize that they need to record the donor's basis when they receive the donation of a capital asset. And many foundations also don't realize that when it comes to publicly traded securities, they're not required to attach reams of brokerage statements to the return. Instead, all sales of publicly traded securities are consolidated on one line of the return, and there's no need for supporting details. Here we see the foundation's tax liability in Part 5, line 5. This would be 1.39% of the foundation's net investment income that we calculated on page 1 in column B. Now let's turn our attention to the minimum distribution requirement, or MDR. When we speak to clients, we use the term minimum distribution requirement, or MDR, to mean the minimum amount that must be distributed by the end of the current year to avoid a 30% under distribution penalty. This is the term that most people can relate to because it tells them what they need to do by the end of the current year. However, the IRS refers to this as the 2022 undistributed income, or UI. And the reason that they do this is because they relate the payout requirement to the prior year's investment asset average. So for example, we would call the amount that must be distributed by the end of 2023 as the 2023 MDR, whereas the IRS would refer to that amount as the 2022 UI. Now we turn to one of the most common questions that foundations have, which is, what is the foundation's payout requirement, and did the foundation satisfy it? So to figure this out, we need to know where to look to find the foundation's payout requirement, and we also need to know where to look to find all the foundation's qualifying distributions for the year. This is the currency, so to speak, that the foundation uses to satisfy its payout requirement. Here in Part 12, line 2A at the top, in column C, in the highlighted area, we see the foundation's 2022 MDR, which is about $270,000. If the foundation didn't distribute at least that amount by the end of 2022, it would have an under-distribution penalty on any shortfall. Qualifying distributions are composed of grants and qualifying expenses, which appear on the first page in Part 1, column D, as we saw earlier. However, there are other types of qualifying distributions that also can be applied towards satisfying the payout requirement. Those include amounts paid to acquire charitable use assets, which are assets used directly in carrying out a charitable program of the foundation. Also, amounts that are set aside under special rules for future grants and special projects. And finally, investments known as program-related investments, or PRIs, which are investments that seek a social return rather than a financial return, and that meet certain requirements in the regulations. Now, let's just briefly revisit Part 1 and note that at the bottom of Part 1, column D, that reports the sum of all qualifying distributions that include grants and qualifying expenses. And here, the total is about $270,800. Note that this column must be prepared using the cash method of accounting, even if the foundation is otherwise on the accrual method of accounting. Meaning that if a foundation has amounts that are pledged to be granted but not yet paid in the return year, those amounts cannot be used to satisfy the foundation's MDR. The most common mistakes here include counting expenses that, again, have accrued but not yet been paid before the end of the year. Also counting certain prohibited expenses, such as any expenses incurred for things like lobbying and electioneering cannot be counted as qualifying distributions. Also, and this is very common, causing the foundation to make more grants than necessary to meet the payout requirement because of a failure to apply qualifying expenses towards the satisfaction of the payout requirement. And lastly, failure to bifurcate an expense that might be partly an investment expense and partly a qualifying distribution. A good example of this could be an invoice from a law firm for $10,000, where $7,000 was used to amend the foundation's bylaws, and $3,000 was attributable to negotiating a subscription agreement for an investment. So in a case like that, $3,000 of that entire invoice would show up in column B as an investment expense, and the other $7,000 that was used for amending the bylaws would appear in column D as a qualifying distribution. Here in Part 11, line 4, we see all the different types of qualifying distributions summed up. We see the total grants and qualifying expenses from Part 1. We see the amounts invested in program-related investments. We see any amounts that were set aside for special projects or grants. And we also see any amounts paid to acquire charitable use assets. So here you can see that the total qualifying distributions was $270,800 approximately. As we saw earlier, the 2022 MDR is a little over $270,000, as reflected at the top of line 2A here in Part 12. The total 2022 qualifying distributions of about $270,800 is carried over here on line 4, as you can see on the left there, and will be used to satisfy the foundation's 2022 MDR. So first, we apply the portion of the total 2022 qualifying distributions towards the return year's MDR. And had there been a shortfall in 2022, we would have seen that on line 6E at the bottom. Now we'll turn our attention to another major data point on the return, which is the foundation's MDR for the following year, which is 2023 in this case. So as we discussed, next year's MDR is based on the return year's investment asset average. However, the regulations exclude any charitable use investments. And they provide specific rules when it comes to calculating the averages of other assets, such as real estate, privately held equity interests, publicly traded securities, and other non-cash assets. The first step in calculating next year's MDR is calculating the minimum investment return, or MIR. Generally, the MIR is the return year's asset average with minor adjustments times 5%. So here this results in a 2022 minimum investment return of about $251,000, as you can see there on line 6. Note that the foundation's asset average is a little bit of a black box in that no worksheets or calculations are attached to the return to show how the foundation arrived at those numbers. So this can make it difficult or even impossible to spot any errors in these calculations. Now, if this had been a short year, such as the initial year of a foundation's existence, it would be necessary to prorate the MIR percentage. And the way you would do that is you would multiply the usual 5% times a fraction, where the numerator is the number of days in existence and the denominator is 365. So just as an easy example, suppose a foundation was incorporated on July 1st, and you would use the fraction of about 182 over 365, multiply that by 5%, and you would come up with 2.5% because you're multiplying it by about half. And that makes sense because if the foundation is in existence for half the year, it would make sense to apply half of the MIR percentage to the asset average. So while the balance sheet shows a snapshot of the foundation's assets at the end of the year, the MIR is calculated by determining the investment asset average for the year. Charitable assets, as I mentioned, are excluded from the asset base in calculating the MDR. And that's why the balance sheet has separate line items for charitable use assets and investment assets. Some of the common errors that we see here including charitable use assets being included in the asset base in order to determine the MDR. That can artificially inflate the MDR unnecessarily. Also, reporting investment assets on the lines of the balance sheet meant for reporting only charitable use assets. Also, incorrectly inflating next year's MDR because the usual 5% MIR percentage was used and not prorated, as we just talked about a moment ago. And lastly, a lot of foundations mistakenly use the end of the year fair market values of the foundation's assets rather than using the asset average and applying the rules and the regulations for calculating the averages. And then lastly, although you can't tell by looking at the 990 PF, I do suspect that a lot of PFs aren't prorating the value of an alternative asset to take into account the number of years that the asset may have been held if it was less than the full year. So for example, if a foundation only held an investment asset for, let's say, half the year, you would only apply half of the value when calculating the average for that asset for the year and incorporating that into the total investment asset average. Next, we use the return year's minimum investment return as a springboard for calculating next year's MDR. In this step, we take the return year's minimum investment return, we back out that year's tax liability, and make any adjustments for any recoveries that may have taken place. The resulting number is the distributable amount, which is the tentative MDR for 2023. A recovery occurs when a grant or qualifying expense paid by a foundation in one year is returned to the foundation in a subsequent year, which creates a makeup distribution requirement. A recovery in one year will result in a dollar for dollar increase in the foundation's payout requirement for the following year. Let's just take another look at part 12 and just talk about the flow of the numbers on the return. So first, we pay off the return year's MDR in column C, as we saw earlier. And then next, if the foundation made more qualifying distributions than necessary to satisfy the current year payout requirement, any extra qualifying distributions will be applied in column D to offset the next year's MDR, in this case, the 2023 MDR. So here you can see that the tentative MDR started out at 249,756, and then the extra qualifying distributions were applied in the amount of about $600. And then at the very bottom, you have the final MDR for 2023 after taking into account those extra qualifying distributions, which came out to 249,181. As far as pitfalls, in many cases, we see that, believe it or not, the entire grid in part 12 is left blank, and the numbers don't flow in the proper order. So it's important to note that if a foundation does have an underdistribution in a particular year, if it misses its payout requirement, and let's say in the following year, it purposely grants out more to correct that underdistribution from the prior year, the correction of that underdistribution does not take place automatically on the following year's return. It's actually necessary for the foundation to make an election on the return itself, and also to attach an election statement to the return, and finally to have that election statement signed by the foundation. And a lot of times we see either that the foundation did none of these things, or maybe they made the election on the return but didn't provide an attachment, or maybe they did both of those things but simply forgot to have it signed by the foundation. Another very common mistake here is using banked excess grant carryovers from prior years to satisfy the current year and or the next year's payout requirement before applying any of the current year's qualifying distributions. And so that just is clearly against the rules. The current year qualifying distributions must always be applied first, because this has the effect of constantly refreshing any carryover that the foundation may have. And under the rules and the regulations, the carryover is supposed to expire every 5 years. But if you apply the carryover first before current year qualifying distributions, you would be continuously refreshing it, and it would effectively have no expiration date. Now let's take a look at how the IRS inquires about possible foundation violations. Part 6B is used to report potential and actual violations of the foundation rules that you see here. And if a foundation violates one of these rules, they need to report it on the 990-PF. So first, we'll look at self-dealing. You'll see here that the IRS asks whether the foundation engaged of any one of a number of different acts or transactions that could result in self-dealing. And then they ask whether any of those acts failed to qualify under one of the exceptions in the regulations. So the wording is a bit awkward here, and oddly enough, the answer that would indicate compliance is that no, none of these acts failed to qualify for an exception. In the event that a foundation must answer yes to that question, indicating that one or more of the acts did fail to qualify under an exception, that would be an indicator to the IRS to expect a Form 4720 to be filed by the foundation. Form 4720 is the penalty return, where the foundation would be required to explain all of the details in connection with the violation and also calculate the related penalty. Note that the self-dealing penalty in particular, and this is the only foundation violation that this applies to, the self-dealing penalty must be paid by the foundation insider that was involved, not by the foundation. And in fact, if the foundation were to pay the self-dealing penalty, that would actually trigger another separate self-dealing violation. So we need to be very careful about who pays these penalties. In this section, it's not good enough that the foundation is telling the IRS whether there were any self-dealing violations in the return year. The IRS also asks whether there were any violations in prior years that were uncorrected as of the beginning of the tax year. And so the reason they ask about that is because the self-dealing penalty is actually reassessed for each year that it remains uncorrected. And in fact, for some types of self-dealing, it's actually considered a new violation in subsequent years. Similar to self-dealing, the foundation is required to disclose prior year under distribution violations that weren't corrected by the end of the current tax year. Note that the 30% penalty on under distribution is reassessed for each year that it remains outstanding. So you could see how this could quickly build up if left uncorrected for many years. Next up is the question about excess business holdings. So the excess business holdings rules generally limit the ownership interest that a foundation and its insiders collectively can have in an active business. Line 3A reflects the de minimis rule, which allows a foundation to hold up to 2% of an active business without taking into account the ownership interest of any insiders, as long as the ownership interest of the foundation doesn't exceed 2% in vote or value. So an active business or a business enterprise, as the regulations call it, is an entity where more than 5% of the gross income is income derived from active income sources, such as the sale of goods or services. However, note that there's no limitation on a foundation's ownership interest in a passive investment vehicle. Now, a passive investment vehicle is an entity where 95% or more of the income is derived from passive sources, such as interest, dividends, rent, royalties, and the like. So that's why the yes box shouldn't be checked if the foundation owns more than 2% in a mere passive investment vehicle. While we can't dive into the details of the rules here, I do want to point out that there is a look-through aspect to these rules, meaning that where a foundation has an ownership interest in a passive investment vehicle, and that passive investment vehicle has an ownership interest in an underlying active business or business enterprise, the foundation is deemed to hold a proportionate share of that underlying business. So you can't always just stop the analysis at the passive investment vehicle level. You sometimes have to keep looking down to see if there could be any excess business holdings concerns in connection with underlying entities. Here we have the section of the return asking about jeopardizing investments. You can think of a jeopardizing investment as one that was made without exercising ordinary business care or prudence. Now, just bear in mind that the jeopardizing investment rules don't apply to assets that were donated to the foundation. They only apply to assets that were purchased by the foundation. Now on to taxable expenditures. Taxable expenditures are disbursements that are either flatly prohibited or can be made following only if the foundation follows certain procedures, or if the foundation obtains advance IRS approval before making the expenditure. If a foundation incurs a taxable expenditure, the penalty is 20% of the amount of the expenditure. So, for example, a foundation is always prohibited from making any expenditures, as I mentioned earlier, having anything to do with lobbying or electioneering or anything for a non-charitable purpose. On the other hand, certain kinds of grants to individuals, such as scholarship grants, are permitted, but only if the foundation obtains advance IRS approval. Note that line 5A3 is not asking generally whether the foundation made grants to individuals. Rather, it's asking very specifically if the foundation made any grants to individuals for travel, study, or other similar purposes. So if the foundation made grants to individuals, but it was for something else, such as, let's say, hardship assistance or emergency assistance, then the foundation could answer no here. Line 5C asks specifically about expenditure responsibility grants, which are grants that require special oversight because they're made to organizations that aren't recognized by the IRS as public charities. So if a foundation reports on line 5A4 that it made a grant to an organization that wasn't a public charity, then it would need to indicate here on 5C that it exercised expenditure responsibility. Otherwise, a violation would result, and by answering no to the expenditure responsibility question, that would be flagging for the IRS, again, to expect a Form 4720, a penalty return from the foundation. Just note that even if a foundation makes a grant to another private foundation, which is another 501c3 organization, expenditure responsibility will be required because the rules say that a grant to an organization other than a public charity, not just any 501c3 organization, but specifically a public charity, any grant to an organization other than a public charity requires expenditure responsibility. And this kind of throws a lot of foundations off because they know that it's a 501c3 and it's kind of like, why do we need expenditure responsibility when granting to another 501c3? But the expenditure responsibility rules do in fact apply to any grant from one foundation to another. Now, as far as expenditure responsibility requirements, most foundations don't realize that in any given year, the foundation will need to include an expenditure responsibility attachment to the return. In any case where the foundation made an expenditure responsibility grant in that year, or where there were outstanding grant funds in the hands of a grantee during that year, or any year in which the foundation received an annual report from the grantee in that year. Let's take a look at some common pitfalls when it comes to reporting taxable expenditures. Now, as far as scholarship grants, a scholarship grant to an individual is, of course, a grant for travel, study, or similar purposes. However, note that a grant to a university to support its scholarship fund is actually not considered a grant to an individual at all. It's considered a grant to the university. The only exception to this would be if the foundation had the ability to select the individuals that these scholarship grants would be going to. But as long as the foundation doesn't have any control over that, and it's just a grant to the university for purposes of its scholarship program, it's not a grant to an individual at all, and the foundation can answer no to line 5A3. Now, bear in mind also that the expenditure responsibility rules that we talked about a minute ago are very unforgiving in that there are several steps involved, and if the foundation were to miss even one of those steps or one part of those steps, the IRS can deem the foundation to not have exercised expenditure responsibility at all. So, for example, let's say a foundation did the required pre-grant inquiry, entered into the required grant agreement, and even obtained the annual reports that are required from the grantee organization, but it simply failed to attach the required expenditure responsibility statement to the return. That can actually ruin the entire thing. And there have been IRS rulings to that effect where the foundation was deemed to have not exercised expenditure responsibility, and it resulted in a taxable expenditure violation, even though they did almost all of what they needed to do. And importantly, even amending a return in a case where all the foundation forgot to do was attach that expenditure responsibility statement, even that hasn't been found to be sufficient by the IRS in several rulings. So it's very important to follow those rules to the letter. So finally, we'll turn to Part 6A of the 990 PF, which discloses information about the foundation's operations and activities. If a foundation has made any changes to its formation documents, such as its bylaws or its certificate of incorporation, for example, that haven't been previously reported to the IRS, then the foundation has to check yes to line 3 and also attach a copy of any of those changes. Line 4A asks whether the foundation had unrelated business gross income of $1,000 or more during the year. And if so, the foundation has to answer yes. And this is even if the foundation had a net loss when it comes to unrelated business income. They're asking about the gross. So that's an important distinction there. So if the answer is yes to gross unrelated business income of $1,000 or more, then the yes answer here will again alert the IRS that it should be expecting a Form 990T from the foundation, which again is the form where the foundation reports unrelated business income and calculates the tax, which and the unrelated business income is taxed at the for-profit rates. On line A, per the instructions, the foundation must list all states to which it reports in any way regarding the organization itself or its activities or its assets, as well as any states that it might be registered in as a charitable organization or where it has indicated that it holds charitable use property. Finally, line 10 asks whether any persons became substantial contributors during the return year. And so in order to accurately respond to this question, foundations must keep track of the donors on an ongoing basis and apply a very specific formula in the regulations to calculate whether or not that person became a substantial contributor that year. So in addition to the pitfalls that you see here, another common pitfall that we routinely see is the failure to indicate on the return any state at all in which the foundation reports or in which it's registered. Another pitfall is to report donors as substantial contributors repeatedly every year when the foundation, when the return is only asking about persons that became substantial contributors in the return year. So if someone became a substantial contributor in a prior year, and maybe they're still considered a substantial contributor in the current year under the formula, there's no need to list them again. Once they've been listed, that's sufficient. So that concludes the presentation. We can take a few minutes now for Q&A. I see a question here regarding asset classification. What if a foundation has an asset that is used partly for investment use and partly for charitable use? Which one should it be classified as? So that's a good question. And this is analogous to the case I mentioned earlier about bifurcating expenses. So if you have an asset, and real estate is a good example for this, where part of it is being used for charitable purposes and part of it is being used for investment purposes. So let's say the foundation owns an office building and the first floor of the building is being used by the foundation itself for office space and its staff is kind of operating out of that first floor. And the other 2 floors are being rented to unrelated third parties at market rates. Then the foundation might report that 1/3 of the value of that asset is considered a charitable use asset, and then the other 2/3 are considered an investment asset. And so you could bifurcate those values on the appropriate lines in the balance sheet, and the appropriate amount that's being attributed to charitable purposes will be excluded, as we talked about earlier, from the asset base when calculating the 5% payout requirement. You mentioned that a recovery such as a return grant or charitable expense must be taken into account when calculating the MDR. Can you please provide some practical examples of when or why a foundation might have a recovery? So a common example of a recovery would be where a foundation makes a specific purpose grant to a charity in support of one of its programs, and for whatever reason, the charity needs to discontinue the program or the program no longer needs additional funding. And so any of those grant funds that remained unspent for that purpose must be returned to the foundation. And so if the grant is made in year 1 and the funds are returned in year 2, that's considered a recovery. Another example, which is maybe lesser known, is when a foundation makes a program-related investment, which I mentioned earlier, PRI. Those are the investments that are made for more of a social return than a financial return. And In a case like that, one example would be a loan to a public charity at either no interest or low interest. And so if the loan is made in year one and part of the principal is repaid in year two, that repayment of principal will be treated as a recovery. And so the reason for that is that when a foundation makes a program-related investment, the disbursement of those funds, so in this case, the loan funds, is treated as a qualifying distribution and applied towards the satisfaction of the payout requirement. And so if you don't recover it and use it to boost up your payout requirement going forward, it's kind of like having your cake and eating it too, because you got to take the qualifying distribution in one year and you still got the money back in another year. And so again, the way that it works is that if you experience a recovery in a particular year, it's going to increase the payout requirement for the following year, dollar for dollar. So the nice thing about it is that a foundation will never find itself in a situation where, let's say, again, it gets a significant repayment of principal on a PRI loan, and all of a sudden its payout requirement is instantly inflated by a significant amount. That's not what would happen. Any repayment, any amount that's treated as a recovery, again, will increase the payout requirement for the following year. So the foundation will always have some level of notice as far as the increase. We have time for one more. You noted that when a foundation violates the self-dealing rules or fails to meet its 5% payout requirement, the penalty will be reassessed each year until corrected. Is that true for taxable expenditures as well? So it's actually not true for taxable expenditures. That's just sort of a one-time penalty. But that's not to say that the IRS won't apply interest or perhaps late payment penalties, but it is a one-time thing. So if a taxable expenditure occurs in year one and it's not corrected until year two, the penalty will not be reassessed the way that it would for self-dealing or even for under distribution. So again, I thank you for joining us, and I hope that you found this webinar helpful. Have a great day.